welcome to the Savvy Money Show with me, your host Sean. Now, we're doing things a bit different this time. Instead of going for, stocks to buy, they are still stocks to buy, but we're going for ones that have had a lot of insider trading or a lot of hedge funds buying them up. And to start with, ones with the most hedge funds buying them up. You may notice some of these from my insider trading videos, and sorry about that. And we'll be moving on to undervalued stocks afterwards. Now, Gossamer Bio. They keep poking on up on the ones being bought up by hedge funds and insiders, and I'm wondering what they know. So that's number one on the list. And then we move down to Quad B, which is Quad. I'm not doing a review of these. I'm only telling you that they are one of the top ones being bought up by hedge funds, and giving you that information so you can do your own due diligence if you feel. Celestica and Amphastar Pharmaceuticals, and we go on to iStar Inc. Now, iStar is another one that I would be interested in, as well as Employer Holdings. Now, so Gossamer, iStar and Employer Holdings. iStar and Employer Holdings give a dividend. The PE ratio of Employer Holdings isn't bad, it's 11. It's undervalued compared to pre-Rona. It's a 15% discount. Now, it's considered stable at the moment. And you've got Cardtronics. And DHT. Now, I'm a fan of DHT. A bit of information about DHT. I know a lot about DHT because I've done numerous videos on them. Now, it's got a 15% dividend, and this is what it declared last year. At this time last year. And then what happens is throughout the year it changes its dividend depending on how the profit is done. Now we know this is going to be profitable next year because it has so many tanker stocks on long-term contracts. So this is well worth a buy as well. And we know that last year it was at 15% until all of a sudden it made such a huge profit that it upped it to 42%. I was lucky that I was in it at that time. I'm not selling at the moment in case they do the same thing this year. But of course that was because of the Contango, and then we're guaranteeing the profit for next year. Anyway, I hope you've enjoyed that. We're going to have a quick plug before moving on. I said if Alibaba hits 220, it would be a buy. A couple of days ago it hit 218. Scooped up some then. I sold one of my Tesla shares at 679 and used that to buy a few Alibaba. Now with Alibaba, it's not insider buying, it's undervalued, and I want to go through this. It has better operating margins than Amazon, and it has it's because it's being accused of being a monopoly. But I'm getting tired of these countries accusing companies of being a monopoly when they're the ones who are authorising these takeovers in the first place. They should refuse the takeovers if that's the case. Now, I think this will come straight back to 300 once it's all sorted, and I do think it is a bit ridiculous when you think that Amazon has an operating margin of 5.2% and Alibaba has an operating margin of 19.1%. Amazon has a net income margin of 4.1%. Alibaba has net income margin of 32%. Piotrowski score for Amazon is 5, for Baba is 6. Level free cash flow is 27.33 for Baba, and 8.4% for Amazon. The debt to equity is 1.24 for Amazon and 0.18 for Baba. Baba appears to be in a much better position. The revenue growth is 33.5% for Baba compared to Amazon's 27.7%. And why is this? Because Amazon's a much bigger company, an older company, whereas Baba's at an earlier stage, but it's still a big, huge company. Now, if the Chinese government implemented what they want to implement, it would be a 0.2% of the country's revenue. So it's not going to hurt them as much as the share price has dropped. It's dropped 30% in a short space of time. Remember, the crash was 30%. The stock market crash was 30%. So it's crashed the same amount as the stock market crash. That frightened everyone. So you're getting that kind of price. Now, you might want to consider this because it can go up, it can recover. Now, I think this will all blow over. I think what's happened is it stopped the IPO. America's doing all this with Facebook and everyone else. So China wants to, and America is flexing its muscles with China over its auditing. So China wants to kind of show, it's on top of things in its own country by flexing its muscles with the biggest company in there. But it knows that Baba, its accounting is as good as anyone's in America. It's compliant. So it's chosen Baba first of all. It will go through Baba. Baba will come out of this. If it implements what it wants to, and the problem with China is China can implement what it wants to. There could be no argument. With America, they have a legal challenge against the government. However, the thing is, I think a 5% drop would have been warranted, but 30% no. this is a buying opportunity, and I do think I have bought. I bought in the past and sold when it ran up, and I'm buying again, and this time to hold. Because now I would like your opinions too. Are you guys buying? Are you in, or do you think it's more serious than I am suggesting? See you in the next video.